Hello and welcome to an Introduction to Technical Analysis, Module 2. My name is Jonathan Rom, and in this module we are going to be covering three different topics around the concept of trend. So let's get started. The concept of trend is the real essence of what technical analysis is and what the trader wants to establish. We want to start taking advantage of the various trends in the financial markets. But one of the biggest problems around the concept of trend is that a lot of people read technical analysis reports providing various support levels, various resistance levels, etc., etc. But it's no use to us if we don't understand the psychology that goes behind the creation of these support levels or the creation of these resistance levels in order for us to fully 100% believe in the strength in those various levels. So let's talk about the creation of support level. I mentioned in the previous module the definition of what technical analysis is by stating that it can be defined as the study of price action primarily through the use of charts for the purpose of forecasting a future price trend. However, there's another definition which is very similar, and the definition that we would like to attribute to this particular module or this particular topic is that technical analysis is actually a study of human psychology and the reaction to changing market conditions, their reaction to changing market conditions. So what is support level and what is resistance levels? Well, if I can break it down into the very simplistic understanding on what these are, please bear with me that I've cut up the financial markets into three categories of participants, namely the buyers, the sellers, and the uncommitted. Now, there are only these three market participants at any one point in time in the market. So if we can understand what their psychology is, each one of these categories, we can understand how a support level gets created and how a resistance level gets created. So let's assume for a second that a market has been moving along this given line, this given black line. What we need to understand now is the psychology of each one of those market participants. So let's get going. Let's talk about the buyers. The buyers that bought the market at point A. They are very happy. They're making money. They're now thinking about where they're going to get out, are they going to get out, etc., etc. But deep down inside, and even from a subconscious level, the buyer who bought at point A, who is happy that they bought at point A because they're now in the money, they never bought enough. So even though that a trader is happy with the money that they've made, they're never happy with the amount of shares or the amount of stock that they had bought. They think to themselves, oh, well, if I only knew that this was going to happen, I would have put all my money into this particular stock. So the buyers really want to be buying more stock at this stage, but the risk associated to buying it where the market is currently is a lot higher from where they previously bought it. So they think to themselves that if the market provides them with an opportunity for them to reload or for them to add to their position, they would like to do this if the market comes back to the same mark where they originally bought the market. So the buyers are resorted to buy on the next test of that black line. Let's talk about the sellers. The sellers at point A who sold the market, who were thinking that the market is going to continue on its way down, are now stuck on the wrong side of the market and are taking a loss. However, the psychology of a human being is that no one likes to realize a loss right off the bat. They would like to get out at a break-even point. That's the first thought process that goes behind when you are sitting in a particular loss situation. Where can I get out where I'm not going to lose money? So, if the market provides them with another opportunity and reverses back down towards where they originally sold it at, that will present the sellers with an opportunity to offset their sales by buying the market. So now all of a sudden, we've got two categories of buyers, each for different reasons, that are resorted to buy on the next test of that black line. Now let's talk about the uncommitted people. These are the people that are sitting on the sidelines, watching the market unfold. Every time it comes back down to that black line, the market moves back up again, comes back down, moves back up again, and these uncommitted people are thinking to themselves, sure, I'm not going to let this happen again. If that market comes back down again, I'm also going to establish a new position in that market and therefore be resorted to buy on the next test of that black line. So if we go forward, now the market comes back down to the black line. It presents all three categories of participants with an opportunity to buy the market for their different reasons. Remember that the buyers want to add to their position, the sellers would like to offset their position by buying the market, and the uncommitted want to commit a new trade or a new open position in the market. So therefore, if we take it in the simplistic format that all three categories of participants that are resorted to buy at point B, there is only one way that the market can go, and that is back up again. So this is the real basic analogy or the real basic understanding of the psychology that goes behind the creation of a support level. And then, of course, support is defined as a level that is under the market where buying pressure simply overcomes selling pressure. Remember, of course, that trading or investing is just now a probabilities game. We want to try and get as many of the probabilities in our favor to make money rather than to lose money. So to have a clear understanding on the concept of support or resistance will give us the confidence we need in order to trade on those particular levels. Now, support and resistance, or support at least at this stage, we need to understand what creates a strong support level, what creates a weak support level. And there are four factors that really determine this. Let's go through them one by one. Firstly is the time frame. Remember in Module 1, I spoke to you about the different time horizons that one can utilize in analyzing the markets. It stands to reason that the longer the time frame that you're looking at, a daily picture or a weekly picture or a 12-year picture, the stronger that picture becomes, therefore the stronger that line becomes. So if you're utilizing a long-term chart over a period of 5, 6, 7, 8 years, that support level along that time frame is going to be a lot stronger than a short-term support level, let's say over a 2 30-minute periods or 5 30-minute periods. So the time frame becomes very important in order to enhance the strength of that particular support. The next factor that we need to look at is volume. Now, volume we are going to be discussing when we talking about various indicators in technical analysis, but volume over here plays a very important role, because the higher the volume that is traded on a particular level, it shows that no one wants to see that level break. There's a lot of activity that is taking place at that particular level. So we would want to see a higher volume traded at a particular support level in order to enhance the strength of that support. The third factor is the number of touches or the number of tests that prices have on a given line, on a given support line. It stands to reason, of course, that a support line with only 2 touches on is going to be a lot weaker than a support line that has got 10 touches on. And what this means is that every time a market comes back and tests that given support line, it instills confidence in people. So the more times people have seen prices testing and bouncing off that particular level, the more confident they also feel in participating in that particular trend or in that particular support line. And of course, lastly, it's the activity or the urgencies of the particular buyers or the particular sellers at a particular level. What we see over here is that the market comes with various depths in that market. When I talk about a market depth, you'll often hear people talk about the first bid and the first offer, or the best bid and the best offer. But underneath the first bid and the best bid and the best offer, there is the second best bid, the third best bid, and the second best offer, and the third best offer. And it shows a volume picture, the number of shares that people want to be trading at those particular levels. So what happens is that when a market comes and touches a particular support level, we look at the urgency, which we look at the second level and the third level and the fourth level of the market to see what the urgencies are between buyer and seller. And the more urgency that there is as far as the buyer is concerned when you're talking about a support level, the stronger that level becomes. These buyers do not want to see that particular support level getting broken. So they will try and influence the best buyer or the best seller by bidding up the prices in the particular instrument. So let me show you what I talk about trend lines, because trend lines really is what we're talking about as far as support levels or resistance levels. And what we're trying to establish from a trend line is just connecting the dots over here. So we've got to go think back to our grade 1 nursery or the grade 1 textbooks over there that we used to fill in or join the dots by lines. And this is exactly what technical analysis is. It's actually joining the dots or joining the tracks that buyers and sellers leave in the financial markets. So when we're talking about an uptrend or a support line, we're looking at trying to figure out where the buyers are coming into that market. So all we really need to do is try and establish a trend line that connects as many low points on a particular trend as possible. Now, in this example, we see that the Aussie market and the Johannesburg Stock Exchange over the past 6 years, you can see that prices have tested that red support line on quite a frequent basis. This enhances the strength of that support line. Remember also, if you have a look at the picture, it's a long-term picture. Therefore, the time frame that I'm using over here is very long, which also enhances the strength of that particular support level. But it's not only used for long-term charts. We could also utilize for very short-term trends. So if you have a look at the next example over here, when we're drawing a short-term trend line, this blue line, for instance, we're only drawing it over the period of 1 year, from quarter 1 of 2013 to current markets to current markets at 2014. This particular support line is a much shorter support line than that of the red line. Therefore, the strength of that support line is weaker than the strength of that red line. So we are able now to have a look at the various strengths on the various support levels by looking at the various time frames that we are looking at. Thank you very much for listening to Module 2, Topic 1. Look forward to sharing Topic 2 with you.